On 1st October 16, P company acquired the following non-current investment. The first one is 3 million equity shares of S company by an exchange of one share hmm, in P company for every two shares. So they acquired 3 million of shares and they gave up 1.5 million of their shares. Okay, plus 1.25 per acquired in cash. So they gave cash also. So these are the given information. So they gave 1.25. So they acquired 3 million, and for each of the shares they gave 1.25 in cash. So they gave 3750,000. The market price of each P company share at the date of X 6. So the share that they gave up, their own shares, they gave up 1.5 million of shares, and the fair value was 6 per share. So fair value of the shares given up is 9 million, and the shares that they have acquired, their fair value is 3.25. Okay, so total is 9750,000. Then there is another acquisition which is 30% of equity shares of a company at 7.5 per share. Only the cash consideration of the above investments have been recorded. So they have recorded this cash consideration already in their books, and extracts from the summarized draft statement. So they have the draft statements of financial position of all these three companies. P company acquired S, and they also acquired 30% of A, and they acquired 3 million of their shares, S company shares. So this is the draft extract from the draft financial statements without considering these factors, except that only uh, cash given, the cash consideration is already booked in the books. So they have equity shares of 10,000. These numbers are in thousands, I believe. Yes, these numbers are in thousands. So they have this 10 million of equity shares, beginning return earning, and return earning for the year is this much. It is not ending return earning, because in the question you can read for year ended 30th September 2017, it is this much. Okay, so these are the information already available. The following information is relevant. At the date of acquisition, S company had 5 years remaining of an agreement to supply goods to one of its major customers. The agreement has been consistently renewed. When it expires, the directors of P company estimate that the value of this customer based contract has a fair value of $1 million. So it looks like they have an intangible. Uh, the fair value of that intangible is 1 million. During the year 30th September 17, S company sold goods to P company for there is an intergroup sale of 2.7 million. S company had marked up these goods by 50% on cost, so their cost is 1.8 million, uh, and the intergroup sale is 2.7, and there is an unsold goods of 600,000. Hmm. So here, how much is the profit? If we want to calculate here the profit, uh, let me fix this formatting. Uh, how much is the profit? So 2.7 minus 1.8, this 900 will be the profit, and there is unsold goods of 600,000. So there is definitely unrealized profit as well. So how much is the unrealized? So 900,000. If the cost is 1.8, the profit is 900,000. So unsold goods, it's 600,000, and this is on cost. 50% on cost. So okay, one third they are saying. So 1.8, one third is this 600,000. So the unrealized profit will be how much? I think it is the half, 300,000, because here also you can see now The profit is half of this thing, 50%. So 300,000 is the unrealized profit overall. Third, it is the group policy to value NCI at fair value. For this purpose, the share price of S company at the acquisition date should be used, which is this. Okay. All right. What is the total of the consideration paid? So what they are asking is 302. They are asking uh, total consideration paid by P company. Okay. So we already saw here, you know, what is paid. Maybe we can do this question here only, or maybe we can reproduce this thing down below. Okay. So how we are paying? Hmm? Okay. Mhm. I wanted to paste the values only. Okay. I want to paste values only. Okay. So they have given the fair value of the shares they have given up is 9 million and the cash they have given 3.75. So total consideration is how much? We will take this 9 million plus 375. Okay. So are they giving up anything else? Total of the consideration paid. So 12750 should be the answer. Okay. Third one. Okay. What are they asking in 303? How should the customer contract in note 1 be accounted for? So the intangible they are saying, you know, the customer contract. So it is how we will do this. Should not be recognized. No, no, it will be. It is okay. It is internally generated. The customer thing that they talked about. So it was internally generated, but it was internally generated for S company. Okay, and P company acquired it. So it's acquired for P company, not internally generated. So first one is incorrect. Group share of 75% should be recognized and not amortized. No, because when we prepare the statement of financial position, we record everything at 100%. We do not take the parent entity's share. So second one is also incorrect. Should be recognized at 1 million. 1 million is the fair value that is given in the question. You know, fair value of 1 million. So it will be recorded at 1 million and not amortized. Yes. So this is it. It will not be amortized. Wait a second. Yeah, it will not be amortized because you can read in the facts here. It says that 1 million indefinite life and has not suffered any impairment. So it will be tested for impairment, okay, but it will not be amortized as such. So tested for impairment for sure, but in the facts itself, it is saying that it has not impaired. So the third one should be the answer. Fourth one is also incorrect. It says should be recognized at 1 million, amortized over 5 years. No, it is nothing like that. That it will be amortized for 5 years. So third will be the answer. Will be the answer. What does it say? Recognize at 1 million and do not amortize. Okay. All right. What is 304 asking? What amount will be shown as non-controlling interest? Non-controlling interest in the consolidated statement. So what is NCI? Okay. So for NCI, we see that what was their capital? Their equity was so out of this 4 million. 3 million was acquired. So how much is left? Only 1 million is left. Okay. So their share capital is, so the number of shares is 1 million. Okay. My God. 1 million is the number of shares. And per share value, maybe we can reproduce this thing here. It's fair because it said, that they record it at a fair value. So we will take this 9750. Okay, this one we will take. Then there is this retained earning for the year. For the year, the retained earning is 2900. So that also we need to take. Hmm? 2900. Okay, this is the profit we can say. Profit for the year. Hmm. profit for the year. So NCI is uh, one fourth, I think. Why is it one fourth? Because this 2900 is for the full year, and here our period is October to 17. So we have full year, and then what is that? The fair value is this thing. So profit for the year is how much? So they take this entire profit of 2900 and then they take their share like one fourth, one fourth they will take. And then there is unrealized profit of the share, but we are just taking NCI percentage, which is one fourth. Okay. Unrealized profit also we will take NCI percentage of one fourth. Okay. So what is the NCI? So yeah, we already calculated that unrealized profit was how much? 300,000 here. So we will just take one fourth of it. Okay. So the unrealized, it will be a minus adjustment. How we are going to do is we will take this 3,000 divide by 4. Okay. 75,000. So everything is in thousand. Our profit for the year is I don't know how we are doing it. In millions, if we are doing it, we need to do it this way. Okay, so 9 million. Just a second, I'm just confused with this, thousands thing. So profit for the year is how much? 290,000. 2900,000 means 2.9 million. Okay, so we will take it out of. So they have this 2.9 million. 2.9 multiplied by 1000. So they have this 2.9 million and they will take one fourth of it. Okay. So 725 and then unrealized profit is, so they are taking this 300,000 which is the unrealized profit, and they will take their fourth of this thing. So what will be their NCA 9750 plus this and then minus 75. So I think 10.4 should be the answer for 303. NCI, there's something wrong we are doing probably with these decimal things, because 9750 is this thing, that is true. 303 we are doing, no, 304. So we have this four option, this is not coming any closer to this, we might have missed something. So they have number of equity shares of S companies. Oh, wait a second, it is not 3 million. 3 million was acquired, so they had 4 million. Here in the facts you can see they had this 4 million. Out of this 4 million, 3 million was acquired, so they are left with how much? 4 million minus 3 million, they are left with 1 million only. Okay, they are left with 1 million only. Number of shares S company acquired, we are, or maybe we can simplify this calculation a little bit. What we can do, Hmm, we can say number of equity shares of S company before acquisition. It is 4 million. Let me increase the size. Yeah. And number of shares they acquired is 3 million, and then number of shares of S company left. How much they'll have left is 1 million. Okay, and then what we are going to do, we are going to multiply this 1 million with the fair value, because NCI is recorded at 3.4. Then they have this share of profit, and then they have this unrealized profit. So 3.9 million. This will be the answer. Sorry about that. Yeah. Let's do 305 now. What amount will be shown in the consolidated statement of financial position in respect of the investment in X company, A company. Okay, so they have acquired 30% of it. Hmm. A company also at 400,000 and they acquired 30% of it. Hmm. So they are, I mean, 30% we have acquired. So 30% of share capital we will take. So their share capital was how much? 4,000 into 1,000 means 4 million they had. 4 million they had. Out of this, 30% we are taking, and then the 30% of the profit. 30% of the profit of a company. So for the year, how much profit they had? They had this 20,000. So we are going to this 20,000 and we will multiply it by 20,000, 20 million actually. Hmm? They have 20 million. We will multiply it by 30%, which is parent company shares. Uh, is that the thing? They have how much is the profit there? We are doing question number 305. What amount will be shown as this thing? So we have taken this, but this is actually number of shares. That's what is confusing a little bit here. We have acquired 7.5%. So this we have calculated the number of shares here. We also need to multiply it by the amount per share that we have acquired. So 9 million will be that. And then they have this 30% of the profit. So post acquisition return earning for the year they have shown is 5,000. How much we are taking here? Uh, it is 5,000. So F24 we are taking. Let me redo this. So this profit return earning for the year is 500,000 and we'll multiply it by 1,000 to make it into million, and then we will multiply it by the ownership percentage of 30%. Okay, so it is 1.5 million. So the answer will be 10.5 million. Okay, and then the last question in this series is 306. P company is negotiating a contract to supply goods to A company in the coming year at 20% profit. So P is negotiating a contract to supply goods to A, which is an associate. So how will the unrealized profit on the sale of these goods be eliminated? So how are we going to eliminate this thing? Eliminate the profit on intergroup sale. So there are four options here. So to eliminate the intergroup sale, we debit cost of sales and we credit investment in associate. Okay, so this will be our debit and this will be the credit. So against credit we will place this, debit we will place cost of sales. Okay, so these are the answers. Okay, how we do 302 purchase consideration? Simple. I mean, we gave up our 1.5 million of shares, our fair value are 6 million. So we gave up 9 million worth of shares, and then we also paid per share 1.25. So we acquired 3 million and multiplied by, whatever it was like. It's you know, uh, so cash we gave is 3.75 and 9 million worth of shares we gave up. So our total consideration that we gave was 12.750. Customer contract, it will be recognized at 1 million. It will be tested for impairment, but it will not be amortized as such. And the NCI is number of shares this company before acquisition. It was how much? It was 4 million, then 3 million was acquired, and 1 million is left. 3.25 is the fair value, and in the question it is given that the NCI is valued at fair value. So we'll multiply it by this. We will get the fair value of equity shares, and then the retained earning for the year was 725, and one fourth is the NCI share. Three fourth is already acquired because 3 million out of 4 million was acquired, so only one fourth is left. So we'll take one fourth of the profit for the year, and then there is unrealized profit of 300,000. We will take the one fourth of this. How we calculated that unrealized profit is intergroup sale was 2.7 million, cost they have 50% markup on cost. So if we calculate it, like we can do this way also. Suppose our cost is 100, and then ours, because we have 50% markup, 150 will be our sale price. Okay, so this is how we calculate if we give this kind of questions. So now we know that our sale price is how much? 2.7 million. Okay, so we have this 2.7 million. So what we do? We do cross multiplication. So 2.7 multiplied by 100 and divided by 150. So 2.7 multiplied by 100 divided by 150, we will get 1.8 million. Okay, and then we can do reverse calculation also. They are saying 50% markup, this multiplied by 15%, 900,000 we are getting this, and this is 2.7 million. So this is the profit on total. Okay, but then they are saying there is half of the goods are unsold, right? One third of the goods are unsold. So we divided 1.8 million by 3, we got 600,000. And then the unrealized profit is we calculated because half 50% is the markup. So out of 600,000, 300 is the markup. So 300 is unrealized profit. It is on 100% of things. But then the NCI share is one fourth only. So of the unrealized profit, we take one fourth and we reduce it here. It will go as a negative adjustment. So we'll add 3.25, which is the fair value of the equity shares. We added one fourth of the profits and we deducted one fourth of the unrealized profit, and we arrived at this NCI. Then we have these investments in a company they are asking. So we got their 30% of the capital. So we took the number of shares, we multiplied it by, make it to million, then 30% we are taking, and per share we have acquired it at 7.5. So we multiplied it by 7.5, we got 9 million. Then we took the 30% of their profit. So they have this, five, how much is the profit? The return earning for the year was, I think, 5 million, and we calculated 30% of it. We got 1.5. So total investment in a company is 10.5. And then to eliminate the profit in intergroup sale, our journal entry is we debit cost of sales and we credit investment in associate.